Unit 5, Money Markets, Lecture 3, Types of Money Market Instruments, Part A. We're going to look now at the different types of money market instruments within the various categories. We're going to start by looking at discount instruments, here particularly at straight discount instruments, and we're focusing our attention on treasury bills, bankers' acceptances, promissory notes, and commercial paper. Treasury bills, usually abbreviated as T-bills, are short-term government securities. They're issued at a discount to face value, and upon maturity, the investor holding this asset receives the full face value of this asset. It's a short-term debt obligation. It is backed by government. Here in South Africa, it is backed by the revenues and assets of the Republic of South Africa. It has a maturity of less than 1 year. Now, treasury bills are issued for two main reasons: to fund part of the government budget deficit and for monetary policy purposes. There's a weekly tender for the more common maturities of 91 days and 182 days. There are other special issues of treasury bills with other terms, and they are mainly for monetary policy purposes. T-bills here in South Africa are sold in denominations of 10,000 Rand up to a maximum purchase of 5 million, and as previously mentioned, they commonly have maturities of 91 days and 182 days. T-bills or treasury bills are issued through a competitive bidding process. Here in South Africa, there's a weekly tender for 91-day and 182-day bills, and there are special issues of treasury bills, other terms, and again, this is part of the open market operations used for monetary policy purposes. Again, as mentioned, the treasury bill is issued at a discount to par, which means that rather than paying fixed interest payments like they do for conventional bonds and for yield money market instruments, the appreciation of the bond, that is the increase in the price from issue to maturity, provides the return to the holder. In other countries outside South Africa, for example the US, the maturities on treasury bills range from 13 to 52 weeks. Again, the issuing method is an auction method, as it is here in South Africa. Treasury bills are actively traded in the secondary market, and they're traded again on a discount basis in South Africa, in the UK, and in the United States. In other countries, it is traded on a yield basis, and that is a discount to yield instrument, which we will talk about at a later stage. The discount rate is a rate agreed between the buyer and the seller, and regardless of whether or not this instrument is traded in the primary market or the secondary market, the maturity date and the maturity value remain unchanged. So at maturity, treasury bills are presented to the Reserve Bank, who will issue a check for the nominal or face value of this asset. A banker's acceptance is a discount money market instrument issued by the private sector or an individual. It is a bill of exchange drawn on and accepted by a bank, and it is a negotiable security. What we have here is a promised future payment, which is accepted and guaranteed by a bank, and it is drawn on a deposit at the bank. Now, the banker's acceptance specifies the amount of money, the date, and the person to whom the payment is due. After acceptance, the draft becomes an unconditional liability of the bank, So when the bank is presented with this draft, it has to pay whatever sum of money is stipulated on that draft. The holder of the draft, on the other hand, essentially has a security which they can sell for cash. However, they don't sell it at its face value, they sell it at a discount to the buyer who is willing to wait until maturity for the funds in the deposit. So essentially, the return that is generated by the buyer of this asset is the difference between what they pay for it and what they receive when it matures. So officially, a banker's acceptance is a bill of exchange addressed by a company, the drawer requiring temporary finance to a bank, requiring the bank to pay at a fixed future time a certain sum of money to the order of the company. The drawer company is obligated to put the bank in funds on the maturity date of the banker's acceptance. So what a banker's acceptance does is it makes a transaction between two parties who don't know each other safer, because the bank actually sits in the middle of this transaction, guaranteeing the creditworthiness of the buyer or importer. So they're widely used for international trade. So for example, if an importer is going to import goods in 6 months' time, then in order to ensure that the exporter is satisfied with the creditworthiness of the importer when they don't know each other, the importer will go to the bank where it will draft a banker's acceptance. Now, the importer has to put the funds plus fees into an account. At this point, the bank will issue a banker's acceptance to the importer, who will then give that to the exporter. Now, at this point, the exporter can actually keep that until it matures and collect the funds from the bank, or it can trade that in the secondary market at a discount to its face value. The maturities for a banker's acceptance can vary between 1 and 6 months. It trades in the secondary market, and bankers' acceptances are issued at a discount with the dealing banks, who tend to quote buying and selling rates. So a promissory note is a negotiable instrument wherein one party, the maker or issuer, makes an unconditional promise in writing to pay a determinate sum of money to the other, the payee, either at a fixed or determinable future time or on demand of the payee under specific terms. Now essentially all that is if you decide to borrow money from someone else, then all a promissory note is, it's a contract between the two of you, and you, if you're borrowing the money, essentially make a promise in writing to repay the money back under certain conditions. Now the promissory note will indicate the principal, which is the amount of money that is borrowed, the interest rate that will be charged on the money that is borrowed, and the date by which repayment should take place, or the maturity date. Now, in the case of what they call a demand promissory note, there is no maturity date is listed, but you have to repay the sum of money whenever the lender demands it. The fact that it's a negotiable instrument means that it can be sold in the secondary market. Looking at promissory notes, the majority are issued for 3-month periods. They're usually issued by companies requiring bridging finance, offered to the dealing institutions and other investors. They are once-off transactions, and they are limited in the secondary market, and they are dealt on a discount basis. Commercial paper is an unsecured promissory note. It has a fixed maturity of 1 to 270 days and very rarely goes any longer than 270. It is a money market instrument which is issued or sold by large banks and corporations to get money to meet short-term debt obligations. These can include accounts receivable, inventories, and meeting short-term payroll obligations. They're issued at a discount to face value, and the interest rates or discount rates reflect prevailing market interest rate. It does not contain any form of collateral, so it is only backed by the issuing bank or corporation's promise to pay the face amount on the maturity date specified on the note. So the characteristics of commercial paper are essentially that they are unsecured negotiable promissory notes issued by corporates and finance companies. There is a large domestic US commercial paper market and euro markets. The US commercial paper and euro commercial paper markets have very different characteristics reflecting their own regulatory environments. They are sold directly to investors and they are not underwritten. A program is agreed in advance and banks place this paper with investors. US commercial paper is a discount instrument, while euro commercial paper is a discount to yield instrument.